This week was brutal. 2 days of U.S. airstrikes on Iran, Trump calling the peace deal a waste of time, silver crashing 4% while oil jumped 7%. And yet, here we are on Friday with silver still holding near $59. Not at 45, not in free fall, not collapsing. That resilience, considering everything that hit this week, it's actually worth thinking about. But today's video isn't about this week. It's about next week. Next week has a concentration of catalysts that will be more significant for silver's direction this summer than anything we just survived. 2 specific events, landing within days of each other, representing the single clearest decision point for silver since January. I also want to explain something a senior Federal Reserve official said this week that almost nobody in the silver space is talking about. It involves artificial intelligence causing inflation in a way that directly changes the monetary policy picture. Let's get into all of it. This is OG Silver Stacker. Every Friday, a clear picture of what actually matters. Let's go. Let's start by appreciating what just happened. Silver absorbed U.S. airstrikes, a collapsed peace process, a 7% oil surge, 44 tons of gold ETF selling, European stocks erasing a year's gains, and Goldman Sachs removing all 2026 rate cut forecasts. And it's still trading roughly where it started the week. Not comfortably, not without fear, but still there. Here's why that matters. What we may be seeing at the current $59 level is a market that's become oversold. So much selling pressure has already been absorbed that new negative news stops producing large price drops. The remaining holders? They're primarily people with longer time horizons. The kind who won't panic and exit on another scary headline because they've already processed months of scary headlines. This doesn't mean the bottom is confirmed. It means the character of the selling has potentially changed, from reactive panic selling towards something more selective and considered. Watching whether silver maintains this character into next week's catalysts will tell you whether we're seeing genuine accumulation or just a temporary pause. Now let me walk you through something genuinely new. John Williams, president of the Federal Reserve Bank of New York, said this week that among the factors driving inflation, the one he's most focused on right now is demand fueled by artificial intelligence. This has received almost zero coverage in precious metal circles, but it directly affects how the Fed thinks about inflation. Let's unpack this. Throughout this series, we've tracked inflation through 2 lenses: supply side, disrupted oil supply, Hormuz closures, geopolitical shocks, monetary policy, excessive money creation, interest rates held too low. Williams is pointing to a third driver that's now large enough to be his primary focus. The AI build-out requires enormous physical infrastructure, electricity, cooling systems, specialized chips, construction materials, data centers, skilled labor. The largest tech firms have collectively spent over $450 billion this year on this infrastructure. That much coordinated spending creates concentrated demand pressure. Too much money chasing too few specialized resources, which pushes prices higher. Here's the genuinely important nuance. AI-driven, demand-side inflation is fundamentally different from oil shock, supply-side inflation. And that difference matters enormously for silver. Supply-side inflation from oil shocks is somewhat temporary and self-correcting. If the conflict de-escalates, oil prices fall, inflation recedes, and the Fed has room to cut rates. We've watched this cycle play out. Peace deal, oil falls, silver gets relief, new escalation, oil jumps, silver gets hit. But demand-side inflation driven by AI investment spending is much stickier. Companies spending $450 billion on AI infrastructure aren't going to stop because Iran and the US reach a peace deal. That spending is driven by competitive necessity, company survival. The belief that falling behind creates permanent disadvantages. This inflation doesn't go away when the Strait of Hormuz reopens. For silver, here's what this means. If most inflation were a supply-side oil shock inflation, we'd have a clear catalyst to watch. A durable peace deal that sends oil lower. But if a significant portion is AI demand-side inflation, as Williams suggested, then the relief catalyst isn't a peace deal. It's a deceleration in AI spending, which isn't happening anytime soon. Now the main event, why next week changes everything. 2 major catalysts landing within days of each other. First, the Consumer Price Index report for June drops Tuesday morning. This will capture the first month that fully reflects renewed conflict escalation. The oil price surge, shipping disruptions, rerouting costs. If June CPI comes in notably hot, it will reinforce the hawkish case for a September rate hike, pushing those odds potentially above 70%, creating pressure on silver. If it comes in cooler than expected, it could provide exactly the relief rally that the technical setup at $59 is positioned to capitalize on. Second, Kevin Warsh's congressional testimony later the same week. This is genuinely historic. Since Warsh took over as Fed chair, he's communicated only through official channels, press conferences, the Sintra appearance. Congressional testimony is completely different. He cannot use carefully scripted, hedged language. Congressional representatives will ask direct questions and demand direct answers. They'll ask if he supports the president's calls for lower rates, what specific inflation reading would make him comfortable pausing hikes, whether he views AI investment as inflationary. His answers will be interpreted as the clearest, least filtered signal of his actual thinking since he took office. Let me illustrate why this conflict situation remains so hard to read. Iran's foreign ministry officially declared this week that the Strait of Hormuz is completely open to all commercial vessels for the remaining ceasefire period. Sounds positive, right? But here's the contradiction. President Trump simultaneously confirmed the U.S. naval blockade of Iranian ports will remain in place until a formal permanent peace deal is concluded. Not a ceasefire, an outright deal. So Iran says the passage is open, while the U.S. maintains a blockade of Iranian ports. These statements are not compatible. A tanker captain deciding whether to route through Hormuz faces contradictory government declarations. Who do you believe? What happens if the situation escalates while you're in transit? The insurance market is making exactly this calculation right now, and premium rates for Hormuz transit insurance remain dramatically elevated. Elevated insurance premiums mean elevated shipping costs, which means elevated goods prices, which means inflation that doesn't fully resolve, even while diplomatic statements say the passage is open. This is how the semantic contradiction translates into continued real-world economic pressure. Here's something that deserves honest explanation. Oil has fallen 17% from its peak, below $80 a barrel. So, why hasn't silver been rescued proportionally? The answer? Asymmetric speed. When oil surges dramatically, markets price in inflationary consequences very quickly, within days. Inflation expectations are forward-looking. Fed rate hike odds jump, the dollar strengthens, silver falls quickly. But when oil falls back, the reverse process is much slower. Inflation expectations don't immediately reverse. Markets know oil can jump back up if conflict re-escalates. Fed officials don't signal they're walking back hawkish comments based on a week of lower oil prices. They're trained to avoid overreacting to short-term commodity movements. The dollar doesn't immediately weaken just because oil is lower. Dollar strength has multiple drivers right now: AI capital flows, relative growth differentials, safe haven demand. So while the inflation headwind from oil has eased, the broader monetary policy environment doesn't reverse at the same speed. The pain came fast. The relief has been slow. Let's talk technicals. The Trading Key report identified $74.80 as immediate key resistance. A sustained breakout above this could target $90 to $92. Failure to clear it risks a retest of $62 support. Here's what that level represents. $74 to $75 is roughly where silver was trading before and after the dramatic January crash. The 30% collapse triggered by the CME margin hike. This area represents the last significant zone where many buyers entered positions that subsequently went deeply underwater. These buyers are now sitting on losses. Many have been waiting for a chance to sell at a better price. When price approaches 74 to 75 from below, this large pool of motivated sellers represents overhead selling pressure, making the level difficult to break through. For next week's catalysts to matter technically, the implications need to be strong enough to push buying momentum through this seller supply. A slightly softer CPI print won't do it. A genuinely cool print, combined with Warsh testimony that sounds less hawkish, might actually assemble enough buying momentum to take a real run at that level. FX Empire described silver as having become a pure macro trade during the Iran war period. Let me unpack what that means. Under normal conditions, silver's price reflects a blend of forces: monetary and store value demand tracking with gold industrial demand from electronics, solar, EVs, supply constraints from mining output, and deficits. When FX Empire says silver is a pure macro trade, they're saying all these individual silver-specific drivers have been overwhelmed by a single overriding force: the macro environment's effect on interest rate expectations and the dollar. Silver isn't trading on solar panel orders right now, not on COMEX inventory. It's almost entirely trading on whether the next CPI print raises or lowers September rate hike odds. Here's what this tells you practically. If you're a long-term stacker, the pure macro trade phase is when silver-specific fundamentals you believe in, the supply deficit, industrial demand growth, Russia sovereign reserve news, physical premium disconnect, are least reflected in the current paper price. This is when the gap between paper price and underlying physical fundamentals is at its widest. History has consistently shown these periods of extreme macro dominance are followed by the sharpest, most dramatic realignment moves once the macro headwind shifts. Let's be completely concrete about next week. Tuesday morning, CPI drops. Consensus forecast expects a reading that reflects oil-driven pressure without being dramatically higher than expectations. If lower than consensus, watch for immediate relief in rate hike probability. Should drop below 60% from current 63%. silver's positive reaction should hold through the session. If hot, above consensus, watch silver for a quick test of $58 support. Whether that holds will show how much structural physical demand exists at these levels. Later in the week, Warsh's congressional testimony. Specifically, watch his response to questions about AI-driven inflation, given Williams' statement. If Warsh uses similar language, it signals the Fed sees the inflation problem as sticky and structural, not automatically resolved when conflict de-escalates, less supportive for silver near term. If Warsh downplays AI inflation, focuses on oil and geopolitics as temporary drivers, more dovish, more supportive for silver. The combination of these two events makes next week the clearest decision point for silver's summer direction since January. Whatever direction the silver moves by end of next Friday will tell you more about what this market believes than anything from this past week. Here's the honest Friday wrap. Silver survived one of its most difficult weeks in months, holding near 59 through airstrikes, collapsed peace process, Goldman forecast revisions, and 74 tons of gold ETF selling. It survived because enough long-term holders stayed put. Whether that resilience means anything beyond a temporary pause depends entirely on next week's CPI and Warsh testimony. The AI inflation point from John Williams is genuinely new and important. If this framing catches on inside the FOMC, it changes the timeline for rate relief in a meaningful way. And the Hormuz contradiction tells you real-world economic pressure hasn't fully resolved despite official declarations. Prepare for next week. Know what you're watching for and why. I'll be breaking down the CPI print the moment it drops Tuesday morning. If this kind of clear, end-of-week framework is what you come to OG Silver Stacker for, hit that like button. Subscribe so you catch the live Tuesday CPI breakdown. And tell me in the comments which matters more for silver next week, the CPI number or Warsh's testimony. I read every comment. I'll see you Tuesday morning.